and welcome to our webinar on solo 401ks. Today we're talking specifically about the solo 401k. We're going to talk about contribution limits, how to get those accounts open, what your options are for a solo 401k, and some stuff on the administrative side as well. Thank you so much for joining me today. My name is Larissa Greene. I'm with Advana IRA. And as we go through this webinar, please feel free to ask questions. There is a question box located in your navigation bar on the right-hand side. Go ahead and get those questions typed in. As we go, I'll be taking questions. And also, I did upload the slides as a handout. So again, looking at your navigation, you're going to see a drop down for handouts, and you'll see the PDF of the slides there for you to download, follow along, or save them and make notes later on. This webinar is also being recorded, so you'll have the ability to review it later or possibly share it. And we appreciate you guys joining us today. Again, my name is Larissa Greene. I've been with Advana IRA since 2011. And I started out sort of doing back office work. I opened accounts, helped people with transactions, did check coding for investment income received by IRAs. I helped pay expenses. So I've done a little bit of everything, but probably about almost 10 years now, they asked if I wanted to do education, business development, and marketing. And that's where I've been ever since. And some of you, if you're local to our offices, I might have met you out and about. I do a lot of networking for Advanta IRA. I also help host our virtual networking event at the end of every month. And I also host a lot of webinars for Advanta. So if you're interested in other topics, please let us know. It's possible that we have one in the archive for you, or we're also always looking to expand the educational topics we covered, and we love to hear from you. My contact information is here on the screen. So if you have a question on something that you would rather go into some personal detail on, please feel free to reach out to me. I'd love to hear from you guys and answer your questions. A little bit about Advana IRA. We've been in business over 20 years, and we are a self-directed IRA administrator. So what that means is that we hold retirement accounts that hold private investments. A little different than a self-directed IRA from a brokerage firm. We don't sell anything at all. We hold the account, you find the investment, and we help you get it done in the name of the retirement account. And we've been doing that for a little over 20 years. We have 2 offices. We're in the Tampa Bay area of Florida and also Atlanta, Georgia. We have 2.5 billion in assets under management. We have over 10,000 clients, and something that we really pride ourselves on is our ability to give every client a dedicated account manager so that they know who they're reaching out to when they have questions of all kinds, whether it's from making a contribution to making an investment. Your dedicated account manager is there to help you. If you are raising capital, so if you're on the other end of that and you're looking for a self-directed IRA administrator, we assign all of your referrals to the same account manager so that you always know who you're working with. And so that's something that's really important to us. It gives everybody the opportunity to create a relationship between them and the person that is helping them with their account. It also helps make transactions a lot smoother. Something that we're going to talk about today very specifically are the rules for contributing to a 401k. We're going to talk about who's eligible for a 401k and some investment strategies we've seen people use. But please keep in mind that we don't provide investment, legal, or tax advice. We don't endorse any products, and all of the information that we share for educational purposes only. We always suggest and encourage you to consult your attorney, accountant, and financial advisor before making an investment, before opening an account, and if you're going to go the route of a solo 401k, before calculating, or in addition to having them helping you calculate your contributions. And we'll talk about why that is shortly. If you're just joining the webinar, I see several people have joined since we got started. Please keep in mind that you are able to ask questions throughout the webinar. You'll type your questions into the question box that is in your right-hand navigation, and also that I did load these slides as a PDF under the handouts box. A lot of times when we talk about things like solo 401ks, there's just so much information, and I know everybody's trying to take all of the information in, but there's some key points that I like to make, especially for the solo 401k, because it is a different type of account than an IRA, and it sort of stands on its own. It allows much larger contribution limits than IRAs. There are a few IRAs out there that allow larger contributions, but typically the 401k is going to allow the largest contribution just based on the formula for contributions. Options for direct checkbook control are available with a solo 401k, so different than an IRA, you do not have to have an LLC or trust in order to have checkbook control of this account. And the ability to finance real estate purchases, tax-free, are available in the 401k, and we'll talk very specifically about unrelated business income tax and how this works and how in certain circumstances it does not apply to a solo 401k. Okay, so let's just jump right in here. What is an employer-sponsored plan? So there's a few components to an employer-sponsored plan, and we'll talk about that in just a second. But basically, it's a retirement plan set up by the employer or sole proprietor to make contributions by the employer as well as the employee. There are a few plans out there that allow employer contributions only, like a SEP IRA. But for the most part, when you're looking at an employer-based plan, you're talking about employer and employee contributions. And even if you're a sole proprietor and you don't have a formally established entity, you can still have an employer-based plan and make both contributions. So a 401k has actually been something that's been established for a very, very long time. And ultimately, at one point, the IRS created IRAs for those that don't have employer-sponsored plans. But the great news is today we have all of these plans available to us, and there are a lot of options for making contributions. Key components of an employer plan, again, a sponsoring business. But this does not mean that if you are a sole proprietorship, you cannot have an employer-based plan, because really you're wearing two hats. You're both the employer and the employee, and that gives you the ability to make not only sponsor the plan, but also make both contributions. So how your contributions are calculated, they are going to be dependent upon the type of entity you have set up or whether or not you're a sole proprietor. You're going to have the participants or employees essentially, and then also the contributions. So you have these sort of components of the employer-based plans, and we'll talk about how each of these components works. As I mentioned, guys, I am taking questions throughout the webinar, so just bear with me if we have a few moments of silence. It's just simply because I'm reviewing any questions that pop up. I did have a question pop up here. Do you need a securities license to set up a 401k plan? You do not. This plan is going to allow alternative investments through Advanta IRA as well as investments into the market, but you don't have to have a securities license. The plan is set up by you as the employer, and then the investments that you make are up to you as the trustee. And typically, you're going to be purchasing things like stocks, bonds, and mutual funds through a brokerage account in the name of the 401k. So I hope that helps. So advantages of the solo 401k, and there are a lot to this plan. So if you're a sole proprietor, an independent business owner, and you're looking to make higher contributions than you would to maybe like an IRA, then this plan is great for that. It has higher funding limits, but also flexibility for the contribution. So even though, for example, this year the contribution limit is for 2023 is $66,000, you don't have to fund it in its entirety. This is definitely something where flexibility is key for business owners. So if this year you had a lot of earnings, you had a lot of profit, and you're looking to maybe offset some of that, you might be able to do that through your contributions. But if next year you find you're a little lighter in profits and you want to contribute a little less, you could do that as well. And contributions are flexible for when you make them as well. And we're going to talk about that in a few slides. You can defer a large amount of your earned income through the employer contributions and employee contributions. And then you can also make a third type of contribution called an employee after-tax non-Roth contribution. And all three of these contributions combined could potentially get you to that maximum amount of $66,000. And if you're over the age of 50, you get a catch-up contribution too that we'll talk about. But please remember, guys, when I'm talking about the solo 401k, I'm mostly referring to Advanta's solo 401k. Now, a lot of these options are going to be available elsewhere as well, but you do have to consult your plan in order to be sure that all of the options that I'm going to talk about today are available if you're not a client of Advanta. So please keep that in mind. And I wanted to mention that specifically because when we talk about the third type of contribution, the employee after-tax non-Roth contributions, those are going to be plan specific. And so if you're looking to make that third type of contribution, you already have a 401k through maybe your employer, a W-2 job, they may not allow that third type of contribution. So always consult your plan if you're not a client of Advanta. Your 401k allows rollover opportunities, so old employers' plans can be rolled into this account, and you can move any pre-tax IRA over to a 401k as well. Currently, the IRS does not allow Roth IRAs to move into a solo 401k or a 401k in general. Just keep that in mind, because we're going to talk about Roth contributions, we're going to talk about in-plan Roth conversions, but Roth IRAs as they exist cannot be put into a 401k. Another benefit to a solo 401k, access to tax-free loans. So different than an IRA, you can actually borrow from your 401k. So that's an advantage to a lot of people. If you ever worked in corporate America, for example, and had a 401k and you had the ability to borrow from your 401k, well, guess what? You can do that with your solo 401k too. So I think that's something that could be a really big advantage to sole proprietors and independent business owners. It also does allow you to escape the unrelated business income tax when you're leveraging real estate investments. And please keep in mind that in some cases, UBIT is still going to apply to a solo 401k. It doesn't completely omit it from a plan, but in the case of debt leveraged real estate, UBIT would not apply. There is options for cost-effective administration, and then of course, the benefit of a Roth 401k. So talking about the solo 401k and more specifically the Roth 401k, it's a really great way to have money put in after tax and grow tax free. Now, the Secure Act 2.0 did make some changes to employer-based plans and 401ks specifically, and I'll talk a little bit about that. But just so that you're aware, typically when you're talking about a Roth 401k, people think, oh, well, that's because 100% of the money in that plan is Roth, and that's actually not usually the case. Usually it's a commingled account, meaning you have some pre-tax dollars and some Roth money in there as well. And as the business owner, because you're wearing two hats, you get to make both the employee and employer contributions. Currently, when you make an employer contribution, it's pre-tax. And I know Secure Act 2.0 made some changes there. We'll talk about that in just a second. But keep in mind, currently, employer contributions are pre-tax. Employee contributions, however, can be designated as Roth contributions as long as the plan allows. So Advanta IRA's plan does allow you to make your employee contributions as Roth. And for 2023, the employee contribution limit is $22,500, or you get a little more if you're making contributions over the age of 50. Employee contributions can be Roth, traditional, or a combination of the two to add up to the annual limit. So if you're looking for some deductions and you want some Roth money in there, that $22,500 can be a combination of both pre-tax and Roth money. And the annual limit for employee contributions is much higher than a Roth IRA. So a Roth IRA this year is going to be $6,500, and modified adjusted gross income levels that limit you from making Roth IRA contributions do not apply to a 401k. So if you make too much money, essentially, to make contributions to a Roth IRA, you don't have to worry about that with your 401k. Those contribution modified adjusted gross income limits do not apply to a 401k, so you can make the Roth contributions as you see fit up to the annual limits. So I mentioned that we're going to talk just very briefly about the changes the Secure Act 2.0 made to Roth contributions in employer plans. Typically, as I mentioned, employer contributions are going to be pre-tax. Currently, that is still the case, although the Secure Act 2.0 did make it so that employer contributions can be Roth. What we're running into currently is that we need to wait for some clarifications from the IRS in order to implement changes in the plan to allow Roth contributions directly from the employer. And that is the case across the board. That's not just Advana IRA. That's anywhere that can administer a 401k currently. We're all waiting for additional information from the IRS in order to implement those changes and allow employer contributions to be Roth. So that hasn't happened just yet. But we anticipate seeing that probably, I would guess, in the next 2 years, but hopefully sooner. But just so you're aware, because I know that it's sort of all over the place, like, hey, these employer contributions can be Roth. but we do need more information on record keeping, Roth contributions for the employer, as well as making changes to the plan documents on making those contributions. Required minimum distribution changes are from the Secure Act 2.0. RMDs, or required minimum distributions, are not required from Roth portion of the 401k. So if you're familiar with a Roth IRA, you know that RMDs, or required minimum distributions, are not required from a Roth IRA. So Secure Act 2.0 basically made it so that the Roth portion of your 401k is not subject to RMDs anymore either. It also changed the RMD age. So for 2023, the current RMD age is 73. But if you turn 73 in 2023, then you already know that your RMD started in 2022. But going forward, in 2024, if you turned 73, then going forward, your required minimum distributions will start at age 73. 401k catch-up contributions will be required to be made as Roth starting in 2026 if you make more than $145,000 in that year. So again, that change has not been implemented yet, but it basically was brought into law by Secure Act 2.0, and the IRS is not requiring that until 2026, again, because they need to give us more information on record keeping those contributions. So we're going to talk now about plan contribution limits, and I included all of the limits for all IRAs for you here, just simply so that you can see the 401k is really going to allow you the largest contribution based on its formula. So it doesn't always make sense for everybody to have a 401k for your sole proprietor and independent business owner, but if you're really looking to maximize your contributions, you could see where this type of account would be a benefit to you. So a traditional and Roth IRA are $6,500 this year. A SEP IRA, although $66,000, just like the 401k is, that amount is 20 to 25% of your total compensation. And so when you look at the formula for a 401k, typically because it has employee and employer contributions that would add up to $66,000, you're typically going to see you can put more into a 401k. The simple IRA is at $15,500, and then I also have ESAs and HSAs up here just for informational purposes. But again, you can see where allowing the $22,500 as an employee contribution plus another 20 to 25% as the employer contribution as well is going to get you to a higher amount each year. And again, these contributions are going to be flexible. So if you decide this year that you're going to max out that account, you can do that. And if next year it doesn't make sense for you to do that, you do not have to. The contributions are going to be flexible in that way. I had a question pop up here, guys. There's a question on who would qualify for the solo 401k, and I will talk about that, but I'll just answer the question very quickly. The solo 401k plan is for employers, partners in the business, and spouses of employers and partners. So if you own 80% of the business and you have a partner that owns 20% of the business, both of these partners are eligible to participate in a solo 401k, as well as their spouses as employees. But if you have employees, you may not qualify for the solo 401k, and I'll talk about that in just a second. So I also wanted to talk about plan contribution deadlines, and this is really important because there is going to be a lot of deadlines coming up for everybody. I know the end of the year seems to be very hectic, especially at Advanta IRA, where people are trying to open accounts, make contributions, get their investments done before the end of the year. And so please make note that if you're trying to make contributions for 2023, here are your deadlines. If you want to make both employee and employer contributions, your plan must be established by December 31st of this year. So December 31st, the plan has to be in place, but you do not have to make your contributions. You just have to have the plan established. So once the plan is established in 2023, then you have for both employee and employer contributions until your tax filing plus extensions. If your plan is not set up by December 31st and you set it up, let's say in January, you can still make employer contributions, and employer contributions can still be made from up until filing deadline plus extensions. So sometimes we have people come up to us and say, okay, well, I want to set up the plan. I missed the December 31st deadline. When do I have to set it up to make my employer contribution? And actually, the case is all the way up until your tax filing plus extension. So if you came to me on October 1st of 2024 to make your 2023 employer contribution, you can still do that. We can help you set up the plan, and you can still make your previous year employer contribution. And I know this is a lot of information. I had a question pop up asking if there's a transcript. There won't be a transcript, but the slides are in the handout. So if you go to your navigation and drop down the handout, you'll have the slides there. And although I know I'm sort of expounding a lot on information, most of the information I'm covering is going to be on each slide. So you can see in the right-hand corner of this slide, I put up when the plan has to be established for the employee contribution and for the employer contribution. Okay, let me just make sure I covered everything here. Okay, so for contributions, again, you can make a contribution for the employee as the $22,500. If you're over the age of 50, you get what's called a catch-up contribution of $7,500, and that's considered salary deferral or employee contribution. So if you think about that, it would be money taken out of your paycheck typically if you were in corporate America, so they call it salary deferral. But we call it the employee contribution so because not every sole proprietor has a payroll set up, right? So making those contributions as a sole proprietor will still work even if you don't have a payroll system set up. And then the additional contribution that I have listed here is the employer contribution. And I know a lot of times people call it an employer match, so I have that here. But we just call it an employer contribution because it's not a match. You have the ability to make the profit sharing contribution that you're probably a little familiar with, and that's 20 to 25% of your total earned income as the employee for the year. So, and that difference, the 20 to 25%, is just going to depend on how your business is set up and how you pay yourself. So just to give you an example, typically the sole proprietor is going to be able to do 20%. So just to give you an idea of how that works. And let's see, employee contributions are considered salary deferral. So there's that definition for you there, and can be made with tax filing deadlines plus extensions, again, as long as you have the plan set up by December 31st. Somebody just asked me also how long does it take to set up the solo 401k? So it just takes a couple of days. Usually, typically, it's the paperwork that we need to set up a time to go over together in order to get it all filled out properly. And then once it's filled out and turned in, our new accounts team can do it in just usually 2 to 3 days. And so that is just for your information, because I know that people are going to be kind of scrambling to get those plans set up before December 31st, but we really do have plenty of time, but just let's focus on getting that paperwork completed. I had a question pop up on actually closing a 401k and how you do that, and is there a 5,500, do you file a 5,500 sort of as a part of the account closure? That is correct, but actually I would also talk to your CPA and just let them know that you're closing an account. You need to file the 5,500 and make sure that there's nothing else that you need to do, because on the closing side, aside from the 5,500, I'm not 100% sure if there's anything else you would need to do. Again, guys, the handouts are under the handout on the right-hand navigation. You just drop down the handout box and you'll see the PDF loaded there for you to download, review, whatever you like to do. I had somebody ask me if the deadlines I'm talking about are for all 401k providers. Yes, that is correct. These deadlines are going to be the same across the board. They're handed down from the IRS. And so anything that we're talking about as far as deadlines, contribution limits, all of those are going to be the same. Plan options like Roth contributions and loans to participants, those are going to be the things that are plan specific. But anything that's has to do with contributions and deadlines, those are going to be based on 401k plans in general. Someone asked if we offer backdoor Roth IRA. Yes, we do. And actually, I just did a webinar on backdoor Roth IRAs and mega Roth 401ks. So if you're interested in that, you can check out our video archive or send me an email and I'll get that recording over to you. I talked about how in that webinar, I talked about the process for opening or establishing and making backdoor Roth IRA contributions. Okay, so this slide, because I know that's a lot of information on the last slide, you guys, so I like to give you a diagram on how contributions work. And this is for 2023. The contributions go up every year, so keep that in mind as we get into 2024. You're going to have some updates in the amount you can contribute. But I'm using 2023 for you here. where you can see the total amount allowed is $66,000. Now remember, this is based on a formula, so we're going to look at the formula now. If you're over the age of 50, the total is $73,500 because that includes the catch-up contribution. The employer contribution is 20 to 25% of your earned income. So if you pay yourself a salary, for example, then it's going to be based on what you paid yourself for the year. And it's 20 to 25% of that earned income, depending on how you paid yourself and how your business is set up. The second contribution is going to be the employee contribution, and you can either designate those as Roth or traditional, and that's $22,500 or $30,000 if you're over the age of 50. And that's not based on a formula, it's just based on your earned income. So if you had $50,000 in earned income, you could potentially put the whole $22,500 or $30,000 into a 401k. And this is where your CPA is going to be so helpful to you. Make sure they're helping you calculate what you earned for the year and what you can contribute to the 401k. And then the third type of contribution, and this one is going to be plan specific. Your plan has to allow for this third type of contribution. It's an employee after-tax non-Roth contribution. And the purpose of this contribution is to make up the difference in the formula. And I have a sample calculation on the next page. But essentially, when this money goes in, it is after tax, just as the name implies. It goes in after tax. There's no deduction for this contribution, but it grows tax-free, again, because as the name implies, it is not a Roth contribution. It would be considered basis, if anybody's familiar with that term, basically meaning a non-deductible contribution. So it goes in non-deductible, it grows tax-deferred. It can grow tax-free if you take the extra step to file the paperwork to show that you converted it to Roth. And again, it'll be important for you to get your CPA involved when you're handling these types of contributions, and if you want to convert them to the Roth bucket, as we like to say, so that it grows tax-free. I had somebody ask me about Roth contributions, HSA, and 401k contributions. Can you make them all? Potentially, yes. I do talk about that a little bit later, but just to quickly answer your question, there's a potential to make all of those contributions. So here is an example of those calculations that I mentioned on the previous slide. So if John is a sole proprietor and his 2023 salary is $100,000, we're going to calculate how much he can contribute on an annual basis, or at least for 2023. So the employer contribution, again, as a sole proprietor, he's going to get 20%. If he earned $100,000, then he can put $20,000 in as the employer. The employee contribution was $22,500. And so that would be all the contributions he could make if his plan did not allow the third type of contribution. So ultimately, he would put $42,500 into a 401k if he could only do those two types of contributions. But this third type of contribution that is potentially allowed, and it is allowed with Advanta's plan, is an employee after-tax non-Roth contribution, which basically takes $66,000 and subtracts the $20,000 and the $22,500, and that's where we got this $23,500 number. And that will allow him to literally max out the $66,000 allowed for this year. Now, if he was over the age of 50, if you'll recall, he'll be able to do the $73,500, as you can see on this previous slide. But we're assuming John is under the age of 50, so he's not doing the catch-up contribution for this year. And then that would change the employee contribution amount and the total amount contributed. So just keep in mind, though, that contributions are based on your business earnings, your earned income from the business, and how you file for your business. And again, getting your tax professional involved to help you calculate the contribution is the best way to handle that. I had a question pop up on the non-Roth after-tax contribution. If it's not considered traditional and it's not considered Roth, where do they go? That's a great question. It actually is considered traditional because it's going to grow tax deferred. It's just non-deductible. So when you make this type of contribution, if you have no plans on converting it to Roth, then it would be considered basis essentially in the plan, or a non-deductible contribution that you would keep track of with your tax professional. so that when you take distributions at retirement, you don't pay taxes on that contribution again. But typically we would see people make that contribution and then immediately convert it to Roth so that it now grows tax-free. So again, just to reiterate, it is a traditional contribution, it's just non-deductible. So it goes in non-deductible, but it grows tax-deferred like your other traditional contributions, but you have the opportunity to immediately convert it to Roth if you want to, so that it now becomes a part of the Roth bucket and grows tax-free. I have a few more questions that popped up here, guys, so just bear with me for just a second. It does not need to be kept in a separate account. That was another question that popped up here. A 401k is interesting as far as administration of the plan goes. The IRS just requires separate record keeping. They do not require separate accounts. So all of your contributions can go into a single account as long as you are doing separate record keeping for contributions and investments made. And then how does the IRS know that it is not a pre-tax contribution? You're going to file an additional tax form with your tax professional every year to keep track of the contribution. So basically you're alerting the IRS that you made a non-deductible contribution when you do so. So we have a whole webinar on this, and this is where your after-tax non-Roth contributions come in with an immediate conversion to the Roth bucket. Because it is tax deferred and not tax-free in growth, typically people will make the move to take an extra step and convert the non-Roth contributions over to their Roth bucket. And because it can be immediately converted, you can see where you could really get a lot of money on an annual basis into the Roth portion of your 401k. And then you could also potentially immediately convert your employer contributions as well. But remember that you're going to pay taxes on that conversion because it went in pre-tax. So all of your contributions can wind up in the Roth bucket if you choose. Your employer contribution currently goes in pre-tax. It can be converted over to the Roth side if you're willing to pay the taxes for that year, and the plan does not pay the taxes, the money in the plan does not pay the taxes, that's a tax burden to you. Your employee contribution can go in as Roth, or if you had any transfers or rollovers to this plan that are pre-tax, those can be converted to Roth. And then of course your after-tax non-Roth contributions can be immediately converted to Roth as well, giving you the ability to have a mega Roth contribution in your 401k, or essentially all of your 401k monies as Roth. And again, if you're looking to do any conversions, any at all, talk to your tax professional so that they can help you understand how that's going to affect your tax liability for the year. And in my previous webinar on Roth conversions, I talked about how Roth conversions are done and paid for in the tax year you do them. So if you do a Roth conversion in 2023, it's going to count for your 2023 taxes. If you don't get to it until January, it's not going to count for 2023 anymore. It is now going to count for 2024 because it's in the calendar year. I had a question pop up. I'm over the age of 65. Does that mean I can still do Roth conversions? Absolutely. You can do a Roth conversion at any time. You know, the IRS wants your taxable income. So you can do a Roth conversion in your 401k, in your IRA, regardless of your age. I had another question pop up. So this question is in regards to having a W-2 job, so working, you know, in corporate America, so to speak, and then also having a side hustle or a sole proprietorship or a side business or a business of their own. Can you still have a solo 401k if you're participating in your employer's plan at work? And the answer is yes. Your employee contributions are going to be maxed out across the board. That is per individual, not per business. But your employer contributions are per business. And so even if you're making your $22,500 contribution with your employer, if you have a side hustle or a side business and you want to make an employer contribution, you can do that. And your after-tax non-Roth contributions are also not limited to that $22,500 that you might be making with your employer. So again, this is where your tax professional is going to be important to help you calculate this, but you have the potential to really max out not only your employer plan at work, but also a solo 401k for yourself as well with your own business. When do the taxes have to be paid? And I'm thinking this is for Roth conversions, and that's paid when you file your taxes. So if I did a Roth conversion today in 2023, when I file my taxes in January, February, March, April, that's when I'm going to pay the tax liability from the conversion. The Roth conversion is going to show as a 1099 as ordinary income in the year that I do it. And again, I have a whole webinar on that. If you guys need more information on it, please feel free to email me and I'll make sure to get that information over to you. So one of the benefits to a solo 401k and Advanta's plan specifically is going to be that loans to participants are allowed, and the guidelines for loans to participants are the same across the board. So if your plan allows loans, then these are the rules. The plan must first allow it. It's 100,000 under current provisions of the CARES Act. Actually, I apologize, I did not remove that because it no longer applies. They sunset that rule, I'm pretty sure. It's actually 50,000 or 50% of the total value of the 401k. So it's 50,000 or 50% of the total 401k value. So if the value is 100,000 in your plan, you can borrow 50,000. If the value of your plan is 20,000, then your amount to borrow is only 10,000. So keep that in mind. It's a normal loan with an interest rate and repayment terms, and that is very important. People think because they're borrowing from their own money that they don't have to pay an interest rate and they don't have to pay it back, and that's actually not true. The IRS requires at least quarterly payments, and you do have to pay yourself a fair market interest rate. That sometimes can be tough. People say, well, what is a fair market interest rate? And we've seen them sort of all over the place as far as people say, well, I think the plan should charge, 7 or 8% because that's what interest rates are today. But then, you might say, well, a personal loan would be a higher interest rate. So, we're going to leave that up to you. Again, bringing your tax professional in to help you with this will be important. But ultimately, you can borrow 50,000 or 50%, the lesser of the two. Repayment is within 5 years. There is an exception for if you're borrowing for your own personal residence, and it is a normal loan. If you do not adhere to the repayment terms, the loan would be distributed to you as ordinary income and taxable, and potentially also penalized, because if you're under the age of 59 and a half, which would be considered retirement age, then you are going to have that penalty as well. So please keep that in mind. That's super important when you're looking at this, and especially if you're your own trustee and plan administrator, you want to make sure that you're keeping up with everything that's required. I had a question pop up about a 401k and other employer plans. This one specifically mentions a 412E. I have to be honest, I'm not familiar with the 412E, but I will share this with you. And then also I would talk to a CPA that can assist you with this. But a 401k can go along with other employer plans, but it typically does not for the same business. So for example, if I had ABC LLC and that was my employer in my own business, I could have a 401k for it, but I typically would not also have a SEP for it, and I could not contribute for both of those plans, to both of those plans. So if you have another employer plan for your own business, you typically would not see it, with the exception being a qualified like a defined benefit plan. So a defined benefit plan, and that might be what you're referring to. I'm not 100% sure, and I apologize for that. But a defined benefit plan can also go along with a 401k. And that's essentially a pension if you're not familiar with that term. But you can have a pension and a 401k, but typically you're not going to have, like a SEP IRA, for example, again, and a solo 401k for the same business. You cannot contribute to both of those. If you're a partner in a business and paid by a K2, can you still have a solo 401k? Potentially. Some K2 pays employee payment is going to qualify here, some earned income through, but it has to be considered earned income. So if it's not considered earned income, then it's not going to be eligible to make contributions to a 401k. And I know sometimes these are going to be passive earnings, right? So you can take dividends, for example, from your business. And if that's the case, if you're taking passive dividends or passive distributions from a business, that's not going to qualify you to make contributions to a 401k. And I know a lot of times I'm talking to investors. So you guys know, as investors, a lot of times you don't have what the IRS would consider earned income. And if that's the case, then you can't do calculations to qualify for a 401k because you don't have the earned income to allow those calculations in the plan. My contact information will be at the end of the webinar, and it's also in the handout. So if you're looking to email me directly, please check the slides in the handout, or also, again, I'll have it at the end of the webinar. Thank you guys for reminding me to restate that. I have a few more questions up here. I'm going to move on for just a minute, and then I'll come back to your questions just because we're really going to be short on time here, and I know this is a lot of information. I had the question pop up earlier as to whether or not you can have a 401k and an IRA or both, and the answer is you can have both. You can have a 401k and a traditional IRA or a Roth IRA. Again, you have to have earned income to make all of the contributions that you plan on making. You can also have a health savings account along with these plans and make those contributions. And again, having your CPA or tax professional help you with these calculations is going to be important if you're making contributions to all of these types of accounts or plans. And that's going to be important because sometimes you also have a modified adjusted gross income too high to make contributions directly to your Roth IRA. You might have to utilize that backdoor Roth IRA that we talked about. And also, if you want to max out your 401k, if you do that and you want to make a contribution to a traditional IRA, or your spouse does, then you might have to make a non-deductible contribution to a traditional IRA. So there's a lot of things that go into this. So definitely talk to your tax professional when you're looking at all of these accounts and their benefits. So a question also popped up earlier about employees and who can be excluded from an employer-based plan: individuals under the age of 21, non-resident aliens, and union employees. And for the solo 401k, very specifically, the plan is for business partners and their spouses. And what I mean by that is you can't just say, well, I have employees, but I'm only going to allow business partners and spouses to participate. It just simply doesn't work that way. If you have employees, you cannot have a solo 401k if they work more than 1,000 hours per year or 500 hours for 3 consecutive years. I'm not going to make this determination for you. Again, this is where your CPA is going to come into play here and help you with that. I also could refer you to CPAs, tax professionals, and consultants that can help you understand whether or not your employee would qualify. If you have a solo 401k and you plan on hiring, please check your plan documents, because some plans allow employees to jump into the plan immediately. And if the plan document does allow that, then you would have to close your plan down or adopt a plan that allows employees prior to hiring. That's very, very important. You want to make sure you're compliant for IRS and Department of Labor laws. And so if you're looking at hiring, check with your plan provider to see what might be required before you hire. And again, I kind of reiterate that here in this note: at the time of you have eligible employees, you're no longer eligible to participate in a solo 401k because you have to have a plan with discrimination testing and calculations for contributions and all the good things that go along with it. So here's some investment options for you with our solo 401k plan. There is a lot. I always like to say that the sky is just about the limit for the 401k that Advanta offers. Because we're a self-directed administrator, we allow things like real estates, private lending, single member LLCs, and private placements, private stock, limited partnerships, foreign currency exchange, cryptocurrencies, and the list goes on and on. So if you're looking for alternatives, then your solo 401k plan with Advanta will allow that. If you are looking to do both brokerage account investing, stocks, bonds, mutual funds, publicly traded assets, you can do that with our plan, as well as self-direct into alternative investments. And therefore, you're really sort of diversifying your portfolio in that way. I had a question pop up on checkbook control of the 401k and doing a Roth conversion. Should you open up a separate checking account to keep control of the 401k with the Roth versus traditional funds? You could. Again, the IRS does not require you to do that. They just require that you do separate record keeping. But I have seen clients do that, and it just makes it a lot easier for them to keep track of what was converted and when. So that's absolutely something you could do. I think it's personal preference, but you do definitely want to make note of the conversion when you do it and talk to your CPA. So for example, if you converted, let's say in March of 2023, money over and then made investments, well, then you want to make sure that you're doing the accounting that's going to show that contribution, or excuse me, that Roth conversion was done way back in March before investments were made with that cash or whatever. But just making sure that you're keeping good record and filing the 1099 that needs to go along with that Roth conversion at the time that it's necessary. I have another question that popped up here. If my rental business sponsors my 401k in a particular year, do I have to keep having earned income in the following years to keep the plan in place? The IRS has not given us guidelines on this. And so again, I would defer to your CPA or tax professional to help you understand whether or not that would be required. Could the plan go on even if you don't necessarily plan on having earned income and making contributions? I really don't have an answer for that. So I would defer to your CPA to find out what they might prefer that you do in order to hold or have that account. Question popped up. I'm assuming both pre-tax and Roth money in the 401k can be under the same tax ID. That is correct. Great questions, guys. Keep them coming. We have just a few slides left. I'm going to try to get through them pretty quickly as we're kind of coming up to the end of our webinar. But self-directed 401k rules. Remember that there are rules when you're investing in alternatives. You cannot invest in collectibles or some life insurance. And typically, life insurance is not allowed in an IRA, but a 401k could potentially allow some life insurance investments. Collectibles, meaning antiques, alcohol, artwork, stamps, coins. Coins are allowed as long as their value is based on the metal and what it is trading at, and not based on it being rare or antique. So keep that in mind as well. Prohibited transactions include dealing with a disqualified person, and on my next slide, I'll show you who is considered disqualified. And then unrelated business income tax does apply in a 401k, but not to debt financed real estate. So it does apply if business income is being returned to an IRA or to the 401k, but it does not apply if you're buying real estate in a 401k with financing. So I think a lot of times people are thinking that unrelated business income tax does not apply at all in a 401k, but it does. It just does not apply when you're purchasing real estate with financing. So that's important to note, especially if you're investing into a business and you'll have business income returned to the IRA. So here on this slide, you can see who's disqualified. It's the IRA or 401k holder, their spouse, their parents, grandparents, children and grandchildren, and spouses and business entities of those. So what that means is that if I wanted to lend my son money from my 401k, that would be prohibited because he is a disqualified person. If I wanted to lend money to my own business or to my daughter's business, that would be prohibited. So people up and down your lineal tree, their spouses and business entities of those. And ultimately, the IRS doesn't want you or these disqualified persons to have a current benefit from your investment in the IRA. So let's say that your son works for a company and the company is raising capital and you want to invest in that company and he doesn't own a share or anything in that company. You say, okay, well, I want to invest with that company. But they said, well, if you invest with us, we'll give your son a promotion. Well, that's a current benefit to your son and could be problematic. So keeping in mind that current benefit rule, because I think that really helps people kind of understand whether or not it's an investment they can make. Usually I'll say if you're making an investment for investment purposes, then it's probably okay. If there's something where like, I wonder if I could do this for, and my son is involved or my daughter or my parents, then it's probably not something you're going to be doing. So unrelated debt financed income tax, or when UBIT applies, is again, it does not apply for acquisition of new real property. A 401k account is exempt from paying, UDFI or UDFI basically triggers UBIT. So you guys have probably more commonly heard it referred to as unrelated business income tax. If you operate a trade or business, again, and you receive business income back to the 401k, it will apply in that case. So keep that in mind. Checkbook control versus third-party record keeping. The 401k plan does allow, or more specifically, Advanta's plan does allow checkbook control, meaning that you can open a bank account in the name of the 401k as a trustee and plan administrator. You'll make your contributions and do your rollovers to that checking account in the name of the 401k. You make your investments through there, receive income, pay expenses for assets that are under the 401k name. And in this example, John, as the trustee and administrator, is going to open the account, sign everything as trustee, file tax forms, sign investment documents, calculate his contributions, and essentially administer the plan. Now, if you decide you want checkbook control and you feel like all of a sudden there's just a lot in your plan, you have a lot going on, you can always upgrade to having a third-party administrator, or the reverse is true as well. You can start with third-party administrator and go down to checkbook control. And I'm talking specifically about Advanta's plan now. If you have Advanta do your third-party record keeping, Advanta is basically your bank, okay? We set up an account for you in the name of the 401k. You make your contributions with us. We keep track of those. You make your investments through us. We help you with that. And we do all the record keeping for the plan. And then we also have an option where we consider it full service, where we also do your IRS reporting. So we would help you with things in the third option, with things like Roth Conversions and filing the 1099 and your 5500. So you have a lot of options for the 401k. And I think ultimately you have to decide what you might be comfortable with. And if you start with checkbook control and you don't want to do it anymore, then you can absolutely upgrade the plan, or vice versa. You can start with Advanta helping you with the administration of the plan. And if after a little while you say, hey, you know what, I have a good handle on how Advanta is keeping records, I think I can handle it myself, then you certainly could also go backwards and do checkbook control instead. It's important, again, to keep good records. And I think when checkbook control could potentially become a little more of a responsibility to the trustee is if you're making pre-tax contributions, Roth contributions, and after-tax contributions. You're commingling those funds and making investments. Remember that, like, you really want to think about how that money is going to grow when you're commingling it all in one account and making those investments, keeping in mind, the ratios and things of that. So just having a good record keeping system in place is going to be super important. In both scenarios, whether you have a third-party administrator or you have checkbook control, the trustee, the client, you as the trustee, you're going to sign investment documents. But ultimately, if you have Advanta helping you with your administration, we're going to review the documents for your investments to make sure everything's properly titled in the name of the 401k. The checkbook control account is usually a trust account with a local bank that you control. And sometimes we get a little bit of pushback from banks on checkbook control of the 401k because they're just simply not familiar with it. It's typically a trust account. The 401k plan documents can act as the trust documents, and we write a letter to your bank letting them know how to hold that account so that you can establish that account and do all your accounting. I had a few more questions pop up. So before I talk about our Learning Center, I'm going to put my contact information up here for you quickly. But I see a question on record keeping here. I have a question on when it's best to make your annual contribution, and if your numbers change at the end of every year, is it better to hold off until your taxes are done and you get the final numbers? I'm going to really defer to your tax professional for that. Normally what I see people do is when they talk to their tax professional, they help them calculate, they help the client calculate what they can contribute. And ultimately, the taxes are done and maybe not filed, and then they make the contributions. But thank you for the question. I really would defer to your CPA on the best way to handle that. But typically, people do have their tax professional involved, helping them with their taxes, calculating their contribution so that they can make it and then file their taxes. One more question here, guys. And as I kind of go through this last question here, just make sure to type any of your questions in the question box. We're kind of coming up at the end of our webinar here. If I buy a property with my solo 401k, but I need an extra 100,000, can I use my own money under the investment company, or how do I get a qualified loan from another source? That's a great question. I actually did a whole webinar on using your 401k as, or your IRA or 401k as a down payment. What's important here is how you structure this. So when you have your 401k make an investment, you can't just bring your own personal, will not work. But you can potentially partner your 401k or your IRA with personal funds at the outset to make sure that you have enough for the entire investment. And if you do that, just be aware this is a gray area, because remember that current benefit rule. It cannot be a current benefit to you for using 401k money. You're going to go into this investment based on percentages that you can contribute both from your own personal account and your 401k account. So just a simple example, if your 401k is going to put 80,000 into the purchase and you're going to put 20,000 in, very simply, you only own 20% personally and 80% your 401k. And going forward, those percentages need to remain the same. So you're always going to own 20% personally, which means if you need additional funds for this project, you have to put 20% of those additional funds in from your personal account and 80% from your 401k account in my example. Again, keeping in mind it's a gray area, having your CPA or attorney help you with structuring this to make sure it's structured properly and will not have, you know, an issue ultimately if the IRS ever looked at that transaction, and making sure that when the investment is done, the property is sold, that you receive only your share of the investment and the 401k receives only its share of the investment. How could you get a qualified loan? You certainly could do that. You want to make sure that it's non-recourse. So the loan is non-recourse to the 401k. And that the 401k is making the loan payments. That's super important, because in the case of getting a loan where the 401k puts the money down, gets the loan, makes the investment, then it's the 401k that owns the property and has the mortgage. And in that case, the 401k makes the payments to the mortgage. It's responsible for that, as well as any upkeep and expenses on the property. So again, just keeping that in mind. And if you'd like that webinar, just make sure to shoot me an email. I had a question, does this webinar qualify for continuing education? The answer is I'm not keeping track or giving any sort of continuing education credits, but you can always check with your governing body to see if it would qualify for CPAs, attorneys, real estate agents. We have done those in the past, but again, it's going to be up to your governing body, because we don't currently have this webinar certified for continuing education. Sole proprietor, the question is, sole proprietors don't have a salary. They have net self-employment income, so they cannot participate in payroll. Is there a lot of competent tax preparers that are not CPAs? Oh, excuse me. Thank you, Anna. Yes, and that's why I mentioned tax professional. She's letting everybody know that it doesn't necessarily have to be a CPA, and that's true. And that's why I mentioned tax professionals, because there is also enrolled agents and other certificates out there for tax preparers. So just keep in mind, whoever your tax preparer is, your tax professional is, they can assist you with calculating things like your contributions. And also, to Anna's point, you don't necessarily have payroll, which I mentioned at the beginning of the webinar if you're a sole proprietor. What's going to really matter here is whether you're being paid on a Schedule C, 1099. There's some other ways that you get paid that would qualify, that you're paying self-employment tax on your earned income to qualify those earnings to make calculations to a 401k. Again, some of you are investors, you have passive income that's not considered earned. If you need more information on the definition of earned income, please check the IRS website. They have a whole page dedicated to kind of letting you know what would be considered earned. But ultimately, you would be paying self-employment tax if you don't have payroll set up, and many people don't that have a solo 401k, then it would just be something that would be considered earned, or where you're paying self-employment tax on those earnings. So here's my contact information again, and I'm going to shift this slide just one up to our Learning Center. As I mentioned, I have a lot of really great webinars available. So if people have questions, for example, on Roth Conversions, and things like backdoor Roth contributions, the mega Roth 401k. You can use your 401k or IRA as a down payment. All of these are topics I covered this year, either by myself or with a partner. If you guys are interested in these, please feel free to check our video library, search Advanta IRA on YouTube. All of our videos get archived there, including this one. And you can also, please feel free to email me because I can usually find them a little faster, especially because we do so much education. There's so much on there for you that I'd be happy to send you a specific video if there was a topic I mentioned in a video that you would be interested in seeing that webinar in its entirety. Please feel free to email me. If you have specific questions on your scenarios, please feel free to email me or give me a call. My contact information is there. I don't see any other questions, so I thank everybody for joining us today. I look forward to having you on our next event.